Hi there everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash, with me NikunjDalmia as well as Anisha Jain. And gosh, it's been a very eventful last week. We've had lots of global headlines. What are we waking up to this morning? No shockers or surprises, but it is definitely going to be eventful. That's the SGX Nifty for you today, indicating a cut of about 0.5% or so. But it's been eventful to say the least in terms of what's slated for the week ahead. We've got the US Fed meet, the Bank of England meet, the CPI data is in focus, UK as well as Japan CPI data that will be coming out. And of course, all eyes on the US Fed meet, whether or not they're going to pause on the interest rate hikes, that's going to remain a huge question mark. So, Nikunj, clearly looking at a lot of global events, and this after the fact that we've wrapped up last week with a cut of close to 2%. That little recovery did play out on Friday.
You know, the UBS Credit Suisse bailout, I was hoping that you would see more green on the screen, but unfortunately markets are not reacting to a big bailout. So that just tells you the underlying template of the market is not all that, charged up. This arguably is the most important week from a central bank policy action. Now the Fed in a sense will be the decider. If Fed decides to increase rates, it's an indication that they feel that the US banking system is stable and they are worried about inflation. If they don't increase interest rates, that means that Fed is nervous about the US economy and the global economy's ability to digest another rate hike, and that also could be an indication that markets are slightly fragile in terms of the near-term compulsions. So it's a tricky week to call, but it's an important week which in a sense will decide the course of the short to medium-term market action. What is important here is that, and the price action is not resonating with what the global news flow is, the concerns in the world are getting addressed. The collapse of Silicon Union, SVB, the rescue of Credit Suisse by UBS. Central bankers are burning midnight oil to ensure that global financial markets remain stable and 2008 crisis is not repeated. But that in a sense is not really giving any kind of a relief or impetus to the bulls. So that's the tricky part, that Asia is down and out, Nasdaq futures are up, gold is up, Bitcoin is up, and SGX is indicating that we could be in for a poor start.
Oh, well, yes, and it's very interesting as you point out. It's not like it's a complete safe haven rally or something, because gold is up, but yes, Bitcoin is also, rallying as we speak over the last week as well. But Nikunj, to the point that you talked about the Credit Suisse deal, do you think the contagion that the market was worried about will be over with the deal that is chalked out? Because it's not a very good deal coming in for the minority shareholders, right? It's valued at what, $3.3 billion as compared to the market capitalization of $8 billion, plus the written down value of the bondholders, etc. as well. Do you think this contagion of various banks coming under pressure will at least abate for now?
See, Anisha, if you don't fix it now, then we are looking at perhaps a bigger problem. And the bigger problem, we've seen that collapse of Lehman Brothers, what it actually caused. Ultimately, government had to come out and step them out, and buyouts had happened, where the TARP money was given to the banks, and they, in a sense, then they were able to resurrect themselves. Some banks went under, some banks were merged. So that is a typical pattern in which global financial markets would move when somebody is caught swimming naked. That's how it works. From the lens of Credit Suisse, you may argue and say, okay, what is there for minority shareholders? But when you're a bond investor or when you're an equity investor, minority, you're taking a risk.
Yeah.
The primary objective right now is to keep the depositors safe. So central bankers are keeping the depositors safe. Imagine if there's a run on any other big bank, then what kind of system are we looking at? I mean, banking is a business of confidence. If the confidence goes away, if central bankers don't kick in, then there is a problem. One. Second, when you are an investor or a equity investor or bond holder, you are ultimately taking risk. When the stock of Credit Suisse went up, or for that matter, any stock went up, the upside is also yours. Now, if you are an equity investor and if you are a bond investor, ultimately you're taking a risk. You have to do your homework.
Yeah.
So that's the way how financial markets move. It's not a place for saints, it's a place for sharks. Central bankers have to come out and they have to stem the run on the bank, stabilize the system so that we don't see, when there is a problem, you have to sort it at the initial stage. And if you don't fix it at the initial stage by coming in and giving confidence to the financial markets, then it would have created it would have been a financial Armageddon by now. we would have been staring at scary levels. They would have only be red on the screen, and everybody would have been running for cover.
Yeah, no, in context of that, the markets haven't done too badly. We're just less than 10% away from the all-time high on Nifty as well, despite two banks collapsing in the US, plus this entire Credit Suisse issue. And just to highlight a couple of details, 3 billion Swiss francs is what UBS will pay. They'll also assume liabilities to the tune of $5.4 billion in losses, and 17 billion is what is kind of a write-off that the bondholders are expecting as far as this deal is concerned. But looks like it's a done deal because it's got a lot of backing coming in from the UK, bank as well. You have the backing coming in from US Fed, as well as positive commentary coming in from Swiss government, who's actually brokered this deal. So that is something which the entire global market, Avan, is talking about.
Absolutely, and that's a big headline, the fact that we're taking steps are being taken to stem the banking crisis. How did that play out overnight? A quick check-in. You had most of the US markets which wrapped up in the red. The Dow futures, though, is showing a bit of a green tick. You've got the Asian markets, barring Shanghai as well, that are piggybacking on those Wall Street cues, and for now the SGX Nifty indicating a weak start. But to our markets then, and Friday's trading session had a glimmer of hope, 17,100. We are just on the brink of that level, but we did underperform our peers. We lost out about 1.8% for the week gone by. It was banks, telecom, autos. Those were some of the sectors that fell. FII sold close to $0.2 billion worth of Indian equities. The bond yield fell to about 7.35%, and you did see the rupee as well, which depreciated about 0.6% for the week gone by. So now, Nikunj, if we were just to focus in on what our markets have done, and as she said, not too bad in terms of what we've been thrown up. The fact that on Friday 17,100 was recouped, and now we have positive news from overseas. Do you think that we're likely to pull through from these levels?
SGX is telling a completely different story. Look, we had one good Friday. That's about it. Otherwise, last week was a terrible week, if you frankly ask me. Now, just like one swallow does not, make for summer, one good day does not mean that we are out of the, woods, so to speak. While I was hoping that we could be in for a solid start, and you built on that because global cues are stable, the problems in the world, at least for the moment, they are getting sorted. But if there is nervousness in the market, that means either markets are telling you that they are not done with the selling yet, or markets are decisively waiting for some kind of a view from the Fed before you will see any kind of a price action. The problem with this kind of a market, it's getting very shallow. The bias is down, the participation is low. You don't have very sharp unwinding. So it's this gradual decline where you know that you're headed lower, but you're headed lower slowly. You know that you're not going to go upside, so you don't want to participate. And that's always a very, dangerous market to be in, because the markets are not showing strength, and the lack of participation and the lack of negative price action is forcing everybody not to participate. See, if there's a big fall, markets will fall, they will adjust, value will emerge. That is not happening. The problem is that you've been just getting pushed here, pushed there, pushed there. 2 good days, 1 bad day, followed by 1 good day, another 2 bad days. And that, in a sense, is really taking the momentum out of the market. And it's not a great gratifying feeling if you've participated in the market. And that's having impact on volumes, mood, technicals, participation, narrative. Am I missing something? Yeah.
Yeah, it's very listless, very momentum free, and as you point out, the weakness has been there as far as the volumes is concerned as well. But one asset class which has managed to outperform a tad bit in this fall that we saw last week was gold. In fact, there is scope for gold and silver to touch more gains. That's the word coming in from Gautam Shah, the founder and chief strategist at Goldilocks Premium Research.
I think the beauty about gold is that anything happens in the world, on the negative side, gold is the first to go up. And we've just had too many developments in the last 1.5 years, or rather since the COVID times. And with this development around SVB, we've seen this $100 move on gold. It's already at 1915, 1920. I think it will get past 1970 in the near term and eventually move past lifetime highs of 2017. So there is 7, 8, maybe even 10% upside on gold and about 15 to 17% upside on silver. And we strongly recommend topping up on both these precious metals at current prices and on any small decline. Yesterday, you had a sort of a mini selling climax with the Nifty going close to 16,800. And from there, we've seen a bounce. So I think whatever has happened is very normal. Even the Bank Nifty has reversed from the 38,500 level. And we've seen these bounces a few times in the last couple of months, and they've just acted as a trap. People hope that it's a bottom, but it does not end up being a bottom because the markets go on to make a lower low. So I would remain bearish. The trajectory will remain down. It will be volatile. It's not going to be a linear decline because we live in a very dynamic world where too many things are happening on a daily basis. So you will see a lot of volatility, but the sequence of lower tops and lower bottoms will continue. So I think that the trend is clearly down. Pullback rallies should be sold into. This has been the stance for the last 2.5 months, and this remains. So do not get carried away with the uptake.
Kunal, we went home on Friday thinking that if UBS has bailed out equity markets on Monday morning, we'll do rock and roll, right? UBS has bailed out, global cues are strong, but Asia is down and SGX pretty much has lost whatever I mean, AJS has indicated that markets will lose whatever they gain on Friday. So back to square one.
Okay. So yeah, good morning, Nikunj. You're back to square one, but I would still believe that till the time we hold on to the previous support levels, 16,850 on the Nifty, traders can expect that this bounce would broadly sustain. Now, I think it's going to be a very difficult move on the upside. So I mentioned that as well last week, that even if we are expecting a bounce of say 800,000 points on the Bank Nifty and we bounced off some 500 points, even on Friday's trading session, it was not a clean bounce for the index. There was a point where the index went extremely negative. We were almost at the lowest point of the trading day in the mid part of the session on Friday, and then the last half an hour, last 1 hour broadly or so, we recovered quite smartly. So I think it's going to be a very laborious kind of move for the indices to move up higher and then go into a bounce back process, and I believe that could probably result into some bit of more consolidation. So my sense is that we should be playing in for a bounce from here on broadly till maybe 17,200, 300 mark on the Nifty and possibly a 40,000 odd mark on the Bank Nifty. But then, you have to be very nimble-footed over here. You can't expect that the bounce would see a follow-through on the index like what we saw in the last couple of days. So even if you get a 500-point bounce, for example, on the Bank Nifty, it's always better to square off your positions and then look to buy back when the index gets into a correction.
Okay, fair enough. Let's find out what exactly Nooresh is also betting on. And Nooresh, given what we're seeing on the SGX Nifty, the fact that it's a 100-point plus fall, is that indicative of the fact that Friday's move was just a flash in the pan and maybe we won't see a follow-through in today's trading session?
So what we are starting to see is the fact that, say, the advanced decline ratios have not been bad on the down days. We are not seeing a big crack in the small cap and the mid cap universe when the Nifty takes a downtick. So those are indications that we are trying to form a base here. So closer to 16,800 or say 16,600 going forward. This could be a base. And stock specific action has been there. So there are stocks which are doing well, irrespective of the market conditions. So that tells you there are opportunities on the long side as well. So one should have a more stock specific approach rather than looking at the index. Even in the index, we are seeing the heavyweights like Reliance Industries at a 52-week low. And you have a L&T, which is say a couple of percentage points away from an all-time high. So the fact remains that it's a stock specific market going forward. And every day we'll see volatility with the announcements everywhere, but we've not seen a sharp crack or a sharp crack in the advanced decline ratios also. So for now, 16,800 becomes a stop loss and a buy on the Nifty on dips from here on.
Okay, buy on dips and 16,800 is the stop loss level. But since you pointed out, Nooresh, that it's going to be very, very stock specific, let's get the top recommendations from you.
So I'll go with two large caps first. First is a buy on HDFC Bank. The stock recovered back from that mark of 1530, 1550, which we discussed last week. Now that is the price point where it saw a big gap up move and post that went all the way to 1700. The gap has been filled, retested and now making a comeback. On Friday, the stock made a good comeback. So out here, 1530 now becomes a stop loss and we could go towards 1650, 1700 in the short term. As overall, the long-term range remains at 1530 to 1700. Whenever we get beyond this range, that is where the next trend comes for. So for now, it's a buy on dips with a target price of 1700. Second is a buy on Larsen & Toubro L&T. The stock has made a very strong base around 2050 to 2100. Has not corrected in the corrections over the last few weeks and is now setting up for a triangle breakout about 2200, 2220 levels. The stock came very close to that breakout on Friday as well. I expect it to break out going forward and make a new all-time high and target towards 2500.
Okay, there you have it. That's Nooresh, who's picking out HDFC Bank as well as L&T. Let's find out which are the stocks on Kunal's radar this Monday morning. Kunal?
So a couple of buy calls. The first one is buy on Better Foods. Looks very interesting on the charts, heading towards a breakout about that 500, 2540 mark for itself. So confirming the breakout back again on Friday's trading session. Buy with a target of 600. Stop loss could be kept at 525. And the second would be Band Tech Mahindra. I would still expect that the stock, which had a spate of positive news flow for itself, is looking very attractive and strong on the charts. Looks ripe for a breakout back again about the 1150 odd mark. So would suggest a buy with 1200 as an immediate target, stop loss at 1100.
Okay, so those are the top recommendations coming in from Kunal as well. But time now to welcome on board Steve Brice, the Chief Investment Strategist at Standard Chartered Bank as well. Steve, hi, good morning. Thank you so much for making time and speaking with us. Well, big headlines coming in from the global markets with UBS finally inking that deal to buy out Credit Suisse for around $3.2 billion. What's your initial thought to that? What's your take on this deal? And will it really stem the contagion effect that the street was worried about?
Well, I'm not sure it will, in the immediate future, stem all the contagion risks that we have around the world, right? So, I mean, obviously, we've still got the situation in the US regional banks as well. It does remove a lot of uncertainty, I guess, from a banking sector perspective in Europe. So, it's certainly a positive step, I think, in the big picture. I guess there's two things that we would sort of be looking at from a banking sector concern perspective. Firstly, what does this the deal actually mean for investors' views on different asset classes? Obviously, the AT1s are particularly important in that regard. So it'll be interesting to see what happens when Europe opens there, to see if there's any contagion or sell-off in other areas of that space. And then secondly is that situation in US regional banks. A lot of focus at the moment on their commercial real estate exposure, particularly in the office space, to see whether the liquidity concerns that we've had over recent times morph into something more concerning on the solvency side. Now, that's obviously, we're a long way from that at the moment, but it's something to keep an eye on, I think, before we can sort of signal the all clear from a global financial system perspective.
Right, Steve, morning. What's the expectation then from this very eventful week? We've got a lot of data points lined up, but in particular, do you think that the US Fed is potentially going to pause on those rate hikes and that it is going to be a 25% rate hike on the cards this time, a 25 basis points rate hike this time?
25% would be quite a surprise for markets.
Pardon me. It's a Monday morning, you'll have to excuse me.
So, look, I think our central scenario is that they'll do 25 basis points, but I mean, it can vary on a day-to-day basis, right? Depending on what's happening in the, in the markets, things are very volatile. I mean, if you look at the Bank of America Merrill Lynch Move Index, the bond volatility index, last week we broke through the COVID-19 highs. So that was a big move. Now, we actually went briefly above the high in 2009, but not yet anywhere near the 2008 levels. So the amount of uncertainty on the rate outlook is huge at the moment. And I think what happens in the next 24, 48 hours will be really important for the Fed. But central scenario, 25 basis points. If they were to do 50, I think that would be really bad for market sentiment, given the financial fragility out there at the moment. But I think the Fed probably understands that.
So, Steve, what's the recommendation then at this point of time? How should one, change their portfolio or make incremental investment at a time like this when the markets are actually taking a bit of a slide? You might call it as a buy on dips market or something that you should stay away. Is there more downside coming for the equity markets?
So, I mean, I guess our views haven't changed that much in recent times. So we're pretty defensive in our portfolio allocations at the moment. So if you were to summarize that, we'd say we're overweight bonds versus equities, overweight investment grade bonds versus high yield bonds, and overweight Asia relative to the developed markets. So those are the sort of the three ways that we're positioned in this environment. Most of those factors probably playing into that view at the moment. Obviously, we saw easing from the central bank in China at the end of last week, which just further reinforces our view that they're in a separate part of the economic cycle. So, that's our positioning, and we're pretty comfortable with that at this time.
All right, let you go on that note. Thanks very much, Steve, for taking time out and joining in and sharing with us that perspective on the global markets. Lots to be anticipated now, but moving right on, top market veterans make sense of the global chaos. We spoke with Punita Kumar Sinha as well as Devina Mehra and Rahul Bhasin. Let's listen in to their views on the global shocks that the market has been dealt with.
The psychology of the market too greatly as far as the Fed was concerned. So that might be a thought there. and what that does naturally to the US dollar, and where does, the likes of indexes, what happens to Wall Street and the overall picture globally with equity markets. And naturally, you roll that across to bond yields, currencies, commodities. Look at copper yesterday, down nearly 4%. Gold still sitting at that 1915 sort of handle. I'm looking on the screen now, about 1915. So, yeah, there's big moves out there, big volatile moves.
Ultimately, once this plays out, maybe the impact on the markets may well be positive, because what the markets now are banking on is that because of all these issues, Fed will back off somewhat on the rate hiking. In fact, being like kind of zero weight on banks, we actually went to market weight on banks about 9 months ago, and that has done well for us. So that we still continue. Capital goods, we continue to be overweight, but of course, that story has been playing out for us for a year and a half. So, while it still looks like an outperformed sector,
the transition from the IC engine to the EV engine, you're on a structural growth path. AI is another area which is, you can see around the world that's going to significantly change things. Cybersecurity is another area where you get tremendous amount of growth, right? Engineering services, the world is moving to more and more defense expenditure. So I think you'll see a lot of these kinds of changes taking place.
As an investor, the first thing which we have to remember is that what are the possibilities of SVB kind of situation in India? One, our interest rates haven't risen as much as US Fed had to raise. So to that extent, mark-to-market losses on our treasury portfolio will be limited. Number two, India has implemented Basel III norms for banking system. In US, it has been implemented on a piecemeal basis. Under Basel III norms, you have to maintain liquidity coverage ratio, which apparently wasn't maintained in SVB cases. So to that extent, we are better off.
So if markets collapse further in terms of stock prices, particularly of the banking sector, and the valuations will become a little bit more attractive, and then markets will start looking ahead, potentially if the Fed rate hikes stall. So there could be, while it's going to be a very volatile environment, there will be trading opportunities, I think, in this environment to make money. So the valuations of the banking sector and some of the other sectors where there's been price dislocation actually becomes a little bit more appealing, and emerging markets as an asset class obviously look even more attractive as compared to the US.
Welcome back. While the US futures have gained, you've got the SGX Nifty pointing towards a dip of about 0.5%. So we'll wait and watch what that throws up for our own markets this morning. But moving on then to some big voices. On the sidelines of the ValueQuest Inflection event, Ajay Piramal, the chairman of the Piramal Group, said that India remains resilient despite global crises and will continue to emerge stronger. Listen in.
If we go by what Morgan Stanley says and what many others are saying, in the next 4 years, our economy will be the third largest after the US and China, and ahead of Germany as well as Japan. So that is in some ways the strength of the Indian economy. When FIIs were exiting last year, you all are there, you are the ones who invested in the Indian markets and gave confidence. The collapse, or not collapse, but the crisis of Credit Suisse has not had any impact, I think, on India. whether it is the Hindenburg report where people said, you know, what's happening to governance, what's happening to the Indian markets, it's not transparent, etc., etc. It's still, the markets have taken that in their stride and gone ahead. And you know, we always talk a lot about how regulation in India is very lax and how there's crony capitalism, etc., etc. But just think of it. $210 billion is the deposits of SVB Bank. And what has the Fed done? They have guaranteed that everybody gets it. So all the errors which have been made by the bank are being subsidized by the Fed. Similarly, in Credit Suisse, overnight, 40 billion has been given by the Swiss authorities. Again, it is somebody else's fault, but the people are bearing the cost. And therefore, very often when we are critical of our country, do recognize that there are others who do this in a much bigger way.
Okay, so that was voice coming in from Ajay Piramal talking about a whole host of issues, right from the Hindenburg report to what's happening with Credit Suisse and how India is most likely to become the third largest economy in the world. But that's not the only exclusive we have for you on ET Now. In fact, we spoke with Bisleri CEO Mr. George. He shed some light as to what their plans are with respect to the promoter looking for further buyers. Listen in to that conversation.
We had Mr. Chauhan on our channel a while ago. There's been talks of the Tata Bisleri deal. What would you say, where is the deal going to go henceforth and what's the status of it as of now?
I would say, permit me not to respond to market speculation. We at Bisleri are focused on our task on hand at this point in time. We have a vision plan for 4 years. We are completely focused on that. That's number one. Number two, the largest initiative which has happened is about improving our entire sustainability initiatives on the ground. As we speak, we are one of the first FMCG companies in India to be plastic neutral, that we actually recycle more plastic than what we put into the market. And we are water positive, that we replenish more water onto the ground than what we draw.
That's a word coming in from the Bisleri CEO. In fact, since we're talking about Bisleri, let's also address the latest report which suggests that Bisleri International Chairman Mr. Ramesh Chauhan's daughter, Jayanti Chauhan, will now be running the bottled water company. Now that the Tata Consumer is no longer pursuing a buyout, Bisleri Chairman Ramesh Chauhan spoke to ET and stated that Jayanti will steer the company with the professional team headed by the Chief Executive Officer, Mr. George. And he no longer wants to sell the business. Chauhan had earlier agreed to sell the brand to the Tata Group for an estimated value of 7,000 crore rupees. But Tata Consumer seems to have called off the deal with Bisleri, citing reason as the company's indecisiveness.
All right. Let's move right on then. Lots of stocks that are in the spotlight in today's trading session. We'll begin with GMR Infra. They plan to merge their subsidiary GMR Airports with itself. The merger is expected to be completed by FY24, and my colleague Somit joins in with all those updates. Somit?
Well, there are a couple of announcements when it comes to GMR Airports Infra. Firstly is the fact that the company will be merging its subsidiary, that is GMR Airports Limited, with itself. Now, GMR Airports Infra owns around 51% stake in GMR Airports, while the remaining 49% is owned by Group ADP, and this acquisition was done back in 2020. Now, post the merger, Group ADP will directly own shares in the listed entity, that is GMR Airports Infra, and they will hold close to 32.3% stake via equity and nearly 13.4% stake via OCRPS. Now, OCRPS is optionally convertible, redeemable preference shares, which will give Group ADP right over dividend but no voting rights when it comes to GMR Airports Infra. Now, apart from this merger, or in fact because of this merger, Group ADP ADP will also be paying close to 550 crore rupees to GMR Airports Infra, and this is as per the earnout contracts that were signed at the time of acquisition in 2020. Now, apart from this merger, the company is also looking to raise close to 2,900 crore rupees from Group ADP via issuing foreign currency convertible bonds. Now, the tenure of these bonds will be 10 years and they'll be carrying an interest rate of around 6.76% versus the current cost of debt of GMR Airports Infra, which stands at close to 9%. And these FCCBs will be converted into equity after 10 years at a price of around 43.67, which means that Group ADP could hold around 5 to 8% more in the company over the next 10 years. Now, why they are doing this? To simplify the corporate structure and to elevate Group ADP to the listed entity level. And this fundraise of around 2,900 crore and 550 crore as a payout will also help GMR Airports Infra to reduce its debt and contingent liability. Now, as of December, if you see, the airport entity's debt stood at close to 23,000 crore rupees. Now, as host of approvals will be required from exchanges, NCLT and others, the merger is expected to complete by the end of FY24, that is the next financial year.
So, Amit, thank you so much for joining us with that quick take as to what's happening with GMR Airports. So, again, a bit of rejig happening as far as that company is concerned. But getting you some fundamental ideas now, listen in to what the latest bet is from Chakri Lokpriya. He's betting big when it comes to, I think, Canfin Homes is one of the companies, or Canara Bank is one of the companies that he's quite positive on. Listen in.
You know, I think I'd buy a combination of Canara Bank. Because it's both positional as well as a long-term. Valuations on its side, it's mid-cap, which is a large bank by in itself. I think there's a good solid 40-50% upside from current levels.
All right, lots lined up today on the market. But in the meantime, let's take stock then of some of the stocks on the editor's radar this Monday morning. Two stocks that we're flagging off today. It's Canfin Homes as well as Godrej Consumer. Let's begin then with Canfin Homes. It's in the spotlight as there has been a change of guard. In fact, the latest news indicates that Suresh Iyer has been appointed now as the new CEO of the company. Ex-Bandhan Bank, what does this mean for Canfin?
You know, Avan, I've always said that the change of guard, at least in a financial institution, could really change the fortunes because it's the CEO which, in a sense, you know, the financial sector business is a very easy business. You take money from depositors and you give it to the borrowers. Then why is that every bank is different? That's largely because of risk management, ability to understand the customer and your ability to really expand the balance sheet. Can Mr. Iyer really be the change agent for Canfin? Historically, we've seen the change of the guard, at least in some of the HFCs, they've done rather well. Canfin is a great brand. Their access to capital, I think, is fantastic. Valuations are not looking that stretched. And this is one company where return on equity, where return on capital should be in double digit, where the growth should be in double digit. It is not a very expensive stock. So can there be a mood change? It's not going to be change in numbers immediately, but can there be a mood change? Because historically we've seen that when a private sector CEO comes to a PSU bank, whether it was Bank of Baroda earlier, whether it was PNB Housing earlier, could it be Canfin Housing now?
Okay, so change of guard, and that should usher in a better change in sentiment when it comes to Canfin Homes. Let's move right on then, and it's an FMCG stock that's in the spotlight, Godrej Consumer. Goldman Sachs has come out with their latest report. They're pretty optimistic. They maintain a buy rating with an 1100 rupee target price, saying that the turnaround may gather momentum. And even when it comes to segmental growth, they continue to remain positive, saying that it's actually one of the top picks within this space.
Look, they've taken a lot of decisions and a lot of painful decisions. So Godrej Consumer, to be frank and to be honest, they've gone through a patch of lean growth and patch of lot of reorientation in their product portfolio. Now the report in my hand from Goldman Sachs, they are making a case that guys, they're coming back and they're getting their mojo back. They're coming up with new products. Insecticide, we don't talk about it. It's a big business for them. Liquid vapor, they're trying to in a sense challenge Vicks with a small ticket size. They're looking at coming up with a small size aerosol spray which lowers the price entry point from 115 rupees to 50 rupees. Again, this is eco-friendly. That's what they're claiming. Right. So Goldman Sachs is of the view that product launches, painful consolidation, change of guard and relatively moderate valuations are the facts which in a sense could have impact on the Godrej consumer stock in the near term. I also feel that we are going through that phase of the market where commodity prices have peaked out. Defensives have started moving higher. We don't talk about it, but this is one of those stocks which in last 52 weeks, despite change of guard and despite concerns in terms of pain, has given a 30% return.
Okay, that's Godrej Consumer as well as Canfin Homes. Anisha, let's also find out what other stocks are on our guest radar today.
Oh, well, yes, absolutely. But before we do that, let me go across to Nooresh to try and understand what his view is on Canfin Homes, because that stock has been consolidating for a while because of this entire uncertainty regarding the leadership change. Now with that coming in, would you want to bet on Canfin Homes and any other NBFC name that catches your fancy, Nooresh?
So Canfin Homes in the past has been one of the better performing ones in the housing finance space, but off late it's not been the same. It's gone sideways for a very long period of time. So say from the time of pre-COVID, the stock used to be 550. In between, it went to 700. We are still at 530, 550 levels. And there have been erratic moves. So we've seen in the last 1 year, there have been some very big swings. So it was at 700, then went to 420, then back to 690. And then we went back to almost 460 levels. So technically, it's very tough to take a call here till the time we don't see a clear trend. And say going forward, once we start crossing 570, that would be the first indication, whereas we say the trend has changed for good in the near term. The only thing is now the base has started moving higher over the last 6 months. So 480 to 500 remains a very important support, but the trend is very difficult to make out here.
Difficult to call a trend as far as Canfin Homes is concerned, but let's wrap this point and get a fundamental view as well. Neeraj Diwan also joins us on the show. Neeraj, hi, good morning. Thank you so much for making time and speaking with us. Your take as far as Canfin Home is concerned, do you think the leadership change with Mr. Iyer coming on board is likely to change the fate of the company going forward?
Yeah, good morning. Actually, yes, because the company Canfin Homes had been under pressure earlier, when there was a sudden exit of the top management. I think after that, though valuations have been still attractive, but we didn't see that kind of a rally, though, from the bottom it's come up and it's been consolidating around these levels of 500, 550. But I think based on valuation and the kind of business growth that we've seen there, and which, it has been seen over last so many quarters, I think there can be some re-rating here from these levels. Though it will definitely depend on market behaves in the shorter term. But if you evaluate at least 1 year forward, I think the target of 630, 650 is what our analysts have attributed to Canfin Home. So I think definitely there can be some positive momentum if one is a long-term investor for a 1 year period.
That's the take coming in on Canfin Homes. Meantime, Neeraj, also curious as to how you're reading into Reliance Industries as a stock, given that off late we've seen that choppiness as well as volatility. From the fundamental standpoint, do you believe that there are likely to be potential triggers on the upside and this phase of consolidation may be behind us now?
Yeah, actually, you've seen Reliance had been between the 2200, 2700 band for quite some time. Now it's come closer to the lower end of the band. And there are definitely positive triggers which will come later. Maybe it's the listing of Jio, or it can be the retail arm getting demerged into a different company. All those triggers will come eventually. So valuation wise, definitely after the correction it looks more attractive. It is just, I think, because the way market is behaving, a lot of people have been waiting for these triggers to happen, have not happened. So maybe it's a short-term, I think short-term, fall that we've seen in Reliance. But I think triggers are definitely going to happen going forward. And if one is, is looking at a longer term of 2 to 3 years, then definitely these kind of, falls are opportunities for long-term investors.
Okay, that's the view coming in on Reliance Industries 22-23 is where the stock wrapped up Friday's trading session. But let's shift focus then to the consumer durable space. That's seeing a demand slowdown. And my colleague Vinny joins in with all the key takeaways from the BNK Securities report and what to make of the slump. Vinny.
Absolutely. You know what BNK Securities done? They've done a channel check with distributors and dealers. And now the first sign in terms of ACs, it's summer season. We should be expecting good demand, but there's a slight delay in demand in terms of the pickup that we're seeing coming in for the room AC segments as well. Though they're saying that the inquiry pipeline seems to be strong. So yes, from the second half of March, we could start seeing a better pickup coming in is what the indication is coming in. They're confident that there'll be a good demand pickup in the second half of March. Now, other than that, they're expecting a volume growth at least of 15 to 20% versus the last summer season, that's summer 2022. So summer 2023 will still see a growth despite that slowdown and a slight delay in terms of the pickup of demand. Overall, the dealers and distributors are also witnessing some supply challenges. So that's a factor that we should keep an eye out on. And some of the brands have taken a price hike of around 1,200 to 1,500 rupees in the last couple of months. So keep an eye out on that. Moving on, the fans demand, let's not forget, the BE rating has come into play. There was some inventory of non-star rated fans as well. So the demand as of now is, more for the non-star rated. But yes, star rated also we are seeing an increase coming in terms of demand there as well. It is going to start seeing an improvement. And obviously the price difference they are indicating is very negligible in terms of both these fans, the non-star rated and the star rated fans. So not much of an issue there. But yes, demand pickup for fans is also similar to ACs. A bit of a slowdown in terms of demand there, but expecting to see a pickup from the second half of March. Other than that, in terms of other white goods, refrigerators, the products have seen a muted demand in terms of the pickup there. They're starting to see a recovery again in the month of March, second half of March. And price increases are also taken in the refrigerator segment in terms of 5 to 6% increase in terms of the prices, and could expect a further increase in terms of prices in the month of April as well. Washing machine are seeing a stable demand as of now, and expect a 8 to 9% growth over there is what BNK Securities is suggesting. TVs, the demand has remained weak as they are facing stiff competition. Other than that, brands like LG, Voltas, Dakin, Blue Star are leading the summer season as well, with Lloyd's obviously being among the top leaders. Refrigerators is also seeing a good demand, while Whirlpool is losing some market share on a year-on-year basis. So we'll be keeping an eye out on Whirlpool's market share as well. And LG and Samsung, I beg your pardon, are leading the refrigerator growth, where washing machines also are seeing a good growth in terms of the market share for them as well. So both LG and Samsung together hold market share of around 45% in refrigerators and washing machines as of now.
Thanks very much, Vinny, giving us those highlights there. Expecting summer growth this time around, volume growth to be in the range of 15 to 20%. Meantime, Nooresh, let's get in your thoughts then on some stocks in trade. And what's the outlook within the mid-cap space on the Nifty 500? Incidentally, you did have some stocks that did manage to hold out quite well. JK Paper, a solid 10% nearly, and KPIT Tech as well soared high. Views on the charts?
So JK Paper has formed a base around 350 levels. Yesterday, I think some of the impact could have been from the ETF rebalance. But technically, the stock has been range bound. 350 on the lower end is the support, 450 is the upper band of the stock. And it's been holding on to this band for quite some time. So still, I would expect some bit of a fade off today. If it comes closer to 365, that would be a buy with a stop loss at 350. Has been the best performing paper stock over the last 2 years. So JK Paper looks interesting again for a bounce towards 400 to 450 levels. KPIT Cummins, on the other hand, has been the best performing mid-cap, small-cap IT name. The stock is very close to an all-time high. Again, a little bit of a volumes could be from ETF, but the trend is very clear. Higher tops, higher bottoms continue. A little bit of a fade off towards 840 today could be a buying opportunity.
The take coming in on a couple of these counters, JK Paper and KPIT Tech. But Kunal, it's the auto index which has been on the back foot of late. In fact, 7 weeks on the trot, we have been seeing that that entire space has not really done much. Do you think that's going to be the trend, at least in the near term, auto stocks in the reverse gear?
Yeah, they are into a reverse gear. And I think dominant reasons for that, Anisha, is because the likes of M&M, Maruti, which were two, I would say, good performers for 2022 second half and in the first 1 or 2 months of 2023. These stocks have gone through a very sharp correction. In fact, M&M has, I think, corrected more than 20% from its previous highs of, I think, 1380, 1400 plus levels. Now the stock is at 1100 and below. Maruti Suzuki has corrected from approximately 9,200, 300 levels to 8,300. Tata Motors is also not finding any major kind of a recovery, breaking past about the 450 levels convincingly. So most of these large cap auto names which are actually doing pretty well in the second half of 2022, these stocks have gone to a correction. And I think that's why the sector is underperforming. The charts for M&M as well as Maruti are still not indicative that these stocks have come anywhere closer to their oversold territory, which means that there could be more selling pressure at least for the next couple of days. And till the time we don't see some oversold nature of indicators on these charts, it's going to be difficult to expect that auto stocks would get into a steady recovery or an immediate recovery from here on. So I would probably wait and watch on these auto stocks. But yes, if these names come back into oversold territory, then we may expect a reasonable bounce into this space as well.
So a bit of wait and watch when it comes to the auto index. But Neeraj, what about the entire IT space? There was a bit of a hint of a recovery at the start of the year, and we thought maybe this year is going to be better. But now with this entire BFSI, Armageddon playing out for the markets, do you think it's probably the time to stay away, wait and watch as far as IT stocks is concerned as well?
Yeah, actually, the kind of correction we've seen in IT stocks, even if you name, the large cap stocks like Infosys, has been massive. We saw Infosys coming to 1400 around levels last year also, when there was a talk of this, interest rates going up, inflation picking up, slowdown in growth, from US. So, it's again come down to those kind of level, after bouncing back. So definitely there's a concern in the shorter term. So one needs to wait and watch what the situation unfolds. One, there can be some issues with the BFSI clients, which some of them have, especially the large cap IT names, which have exposure to US BFSI space, Europe BFSI space. So there can be some small pressures here and there for them. So right now also there's no clarity in what kind of slowdown, if it comes, we can see in US. So I think one needs to wait and watch. Though valuation wise, Infosys below 1400 looks attractive. Then again, if one is a very long-term investor, these are companies which have solid business models. They have done very well in adverse of times, and they've recovered very fast from the lows that they've seen in business cycles. So those are all positives for the sector. So one needs to wait and watch, and definitely look at entry at lower levels. So the large cap IT names should be under your radar. And even the mid cap IT, we've seen some good companies which have corrected and still not been able to come back. So there also one can look at opportunities, but I think it's still a wait and watch for now. Let's see how the situation, which is still evolving, pans out in the shorter term.
All right, stay on with us. Let's move right on then and take a look at the management takeaways from Indian Bank. They've guided for a 13 to 14% credit growth in FY23, predicting that NPA ratios will trend downwards. My colleague Harsh joins in with all those updates. Harsh?
Well, yes, we're looking at 13 to 14%, while the banking system in general is looking at 15+% credit growth in FY23. So they're guiding for a slightly slower growth, but what they're saying is they're not going to compromise on margins. So the margin, in fact, was at 3.7% in Q3, slightly elevated on the back of some one-offs, but at the same time, it's a very solid margin, and what they're expecting is that trend to continue. They're expecting 3+%, well above 3+% margins going forward, and what they're believing is that their RAM portfolio and growth there will support those margins going forward. With regard to CASA, of course, deposit book is under the scanner at the moment for pretty much all banks, and what Indian Bank seems to be suggesting is that there's a cannibalization with regard to term deposits from the CASA, and they are also saying that there's a lot of intense competition from alternative investments as well. What they are suggesting is the cost of funds, which is currently at 4.3%, the incremental cost of funds is going at 6%, largely on the back of TDs and the shift to TDs, and they believe that building a new CASA book, starting something afresh is a better approach, and they're trying to optimize the existing branches with regard to CASA as well. With regard to NPA ratios, they believe that that will continue to trend down. There's a bit of a relapse from the restructured book, and that relapse is going to be lower incrementally going forward. The overall slippages for FY23 is going to be sub 2%, and they believe that that is expected to sustain. Agri slippages remain volatile, but management believes that the recovery rate is far better now. And they believe, and they're positive, largely on the back of the fact that 53% of agri loans are backed by collateral. The bank is also one of the key beneficiaries with regard to the resolution mechanism that's working out in the system. Sri Infra, ILFS are some of the exposures they have. MK continues to retain a buy. They believe ROAs will reach 1% from 0.8% predicted in FY23, and target price of 375 is what they've given, which is a solid 35% plus upside.
Okay, so that's the takeaway coming in from the Indian bank management meet, a bit lower in terms of the credit growth versus the rest of the peers and the industry at the moment. Neeraj, but we were earlier speaking about Godrej Consumer, and there was a fresh note that was written by Goldman Sachs as well, and they are talking about how perhaps the worst of the pain period is over for the company and turnaround is expected to gather momentum. Is there any FMCG name that looks very attractive to you at this point of time, and a word on Godrej Consumer specifically?
Yeah, actually, there was a news item also which was there last week regarding rural spend. There's some improvement in rural consumption, so that may also help some of the consumer names. But when you look across, though, they may be defensive right now because like you rightly said, some pain may be over for them, and rural demand is also picking up. But then valuation-wise, you don't find them that attractive. So they've already been trading at 45, 50, 55 times on a forward. So that valuation comfort doesn't come. But definitely they can be treated as a defensive right now, and you can harden them till market choppiness, market volatility gets over. Still again and again that one name, this ITC comes back because valuation-wise, that ITC is still attractive. Their food business, the non-cigarette business is also showing good traction. So I think that is one name which still comes in that category where valuation comfort is also there. So we've seen some correction also happening there. So that can be one name which can be looked at.
All right. What about, Neeraj, some of your top recommendations or picks from the mid-cap space? What is it that you would look at?
So basically, looking at more to do with companies which are into infrastructure, capital good, engineering kind of space. So there are and even domestic consumption. So like L&T among the infrastructure space has been doing quite well. And in last quarter, you see execution picking up also. Order books are very good, whether it's L&T, like you flashed NCC also, there also order books are very good. But among the other companies, we've been bullish on Kalpataru Power. JMC's merged into it, so it's become a bigger company. So that can continue doing well. Some of the companies which are into water and related space, like Ion Exchange, they are doing well, and they've also corrected from the high of 3,500 odd that they saw. We've already seen 10 to 12% correction in those companies. And, even in the pump space, Kirloskar Brothers is one company which we like. The company has been doing well. Their margins are also picking up. Their, volumes also picking up. So there also that valuation comfort is there. So these are the kind of companies. So even, domestic banks, whether it's PSU banks, the larger 3-4 names, or the top banks like HDFC Bank, ICICI Bank, so these are, though there's this evolving situation globally, which can impact the banking space in the shorter term, may not impact, but at least, one view is there that our banking space is in a much better position. So, once this volatility is over, there also you can see a sharp up move coming back in most of these banks which have corrected because of the global, financial problem that we're facing in US and Europe.
And since we're talking about banks, Nooresh, your take as far as HDFC twins are concerned, because there was that news flow as well that the merger has now got a thumbs up from NCLT as well. Do you think that could result in some sort of momentum build up on both of those counters?
So could be a case wherein the stock eventually gets a re-rating. The stock has gone nowhere. So if you look at HDFC Bank, the stock is lower than the price it was in January 2021. So more than 2 years of a zero return, where a lot of banks have relatively done better. The last time we saw a spike was somewhere closer to November, when we saw a possible, say, merger-related tick, wherein the stock went from 1530 to 1630 levels. And then we continued towards 1700. We came back to 1530 couple of days back. So at these prices, the risk reward is good if one wants to play out for that re-rating once the whole merger thing goes off. And I would expect that eventually the stock goes to 1700. But the bigger trend starts when it starts crossing 1700. So at current levels, positive on HDFC Bank as well as HDFC Limited.
Okay, meantime, Neeraj, wanted to get in your take as well on what the outlook is on some of these consumer durable stocks. Just a short while ago, we were talking about that BNK report, which says that demand for fans has not picked up. Volume growth is expected in the range of 15 to 20%. What is your expectation for the upcoming summer season?
What we've seen earlier also, demand for ACs or fans or refrigerators, which are mostly linked to summer season, it picks up later, because right now also I'm from North, so it has not become that hot right now. So basically, second half, towards, beginning of April or end of March is when, it starts getting hotter, and that is when, the demand really picks up. You get a certain spike coming in just a couple of weeks when you see, really temperature soaring. So that I think will come because, I think the demand for refrigerators, ACs specifically, coolers will pick up a little later. So there can be a spike there. So the companies which are into, most of these products, which are refrigerators, ACs or fans and coolers, should benefit. I think there will be that volume pickup, but I think that is yet to come.
Okay, so that's the take coming in as far as how the channel checks are, talking about the AC companies and how one should look at investing into some of those counters as well. But Nooresh, I wanted to come back to the point that we were speaking about the IT companies. The last 10 days were quite eventful with the entire leadership change happening at Tech Mahindra as well as TCS, and now very soon we'll be at the helm of the earnings season as well. Is there any near-term trade that you would like to play when it comes to the IT counters?
So in terms of IT, there's a different view on every stock as such, because every stock is in a different trend. In mid caps, there are some stocks at a 52-week high and some at a 52-week low. So my picks out here right now in the large cap is, say, Infosys again looks interesting. The stock has corrected back to that 1400 mark, 1400, 1420. It had gone up to 1650 levels. And now we are back to the 1400 price, which is important because the low in May and September also was closer to 1350, 1370. So this could be a bounce back trade. Then in terms of a leadership shift, it is Tech Mahindra even in terms of price action. So if you look at the price action, the stock has sustained well over the last 2 weeks and is setting up for a fresh breakout above the 1150 to 1200 mark, which was the high in September. So once this happens, this could be a stock which would go towards 1400. So this would be the picks in the large caps. Then in mid caps, small caps, it's a tough call because the ones you like have already gone up quite a bit, something like a KPIT Tech, etc. So waiting for a little dip in the mid cap, small cap IT space to start participating. But as of now, Infosys and Tech Mahindra look interesting.
Okay, fair enough. That's the view coming in on the IT space. A quick look at the pre-open rates, and given what the SGX Nifty has indicated, it's no surprises to see a cut. For now, it's mild on the Nifty, about 0.33%, and for the Sensex off by about 78 odd points. But let's get those mid-cap ideas going as well. And Kunal, what are you tracking?
So it's a buy on NCC, the stock looking quite attractive on the charts. We flagged off the stock earlier at closer to 94, 96 levels when the stock was heading towards a breakout above multiple resistance as well as a swing high on the monthly chart. So that breakout is confirmed. The stock is trading above the 100 levels. So would suggest a buy with the target now at 112, stop loss at 98.
Suresh, what about you? What's your top mid-cap recommendation?
So that would be a contraband Bharat Electronics, BEL. The stock has drifted from 115 levels back in September towards 90-94. The last bottom for the stock was around 86 odd levels, which was the last breakout point also. The stock is in a downward channel and which could eventually break out above the 9800 mark. So at current levels, the stock looks interesting in terms of risk reward. And I expect it to eventually break out and take a move. And we are seeing the whole PSE pack do well one by one. And the next one, which looks the best in terms of risk reward, is Bharat Electronics. I would expect it to eventually cross into an all-time high as well. And it has been one of the best performing stocks in the PSE space in every cycle. So I expect this to be in the, say, reckoning of a breakout going forward. So Preempting that whole move makes a risk reward very interesting. A stop loss at 88 and an initial target price of 110.
All right, let's move right on then and focus in on the khabar on Dalal Street. Divi's Laboratories has held an analyst meet recently, and the management says that the cost pressures are easing across major and due to major factors. My colleague Pankaj joins in with all that khabar. Pankaj.
So Motilal Oswal, Securities met the management at Divi's and they came out with positive takeaways. Firstly, regarding cost, remember margins has been one of the key concerns as far as Divi's go, and that's why this is particularly quite important that cost pressures are actually easing. Now they have been doing ongoing capex, and they believe that is something which will continue to aid their growth, whether it's gaining of market share, gaining of volume share in existing products. All of this will be important triggers. They believe that they continue to have a moat versus rest of the other API and other supply providers to many companies, and that's one of the key reasons why they are optimistic and they are investing into new facilities. Overall, after the correction, Motilal maintains it's neutral, but the overall takeaways from the meeting seems to be on the positive side.
Okay, Pankaj, thank you so much for joining us with that latest when it comes to Divi's Laboratories and what's happening in that particular company. But let's get you the latest from the international and national headlines as well. New York Community Bank Corp subsidiary enters into an agreement to purchase deposits and loans from Signature Bank, which shut down operations earlier this month. Regulator FDIC said that the subsidiary will assume almost all deposit and loans and all 40 of the bank's former branches as well. Meantime, Turkish President Erdogan announced extension of the deal that allowed export of Ukrainian grain over the Black Sea. Now, the deal was set to expire on Saturday, but the tenure for this extension remains unknown at the moment. North Korean leader Kim Jong-un says that the country should be ready to conduct nuclear attacks at any time to deter war, accusing the United States and South Korea of expanding joint military drills. Kim's remarks come as the country exercised nuclear drills recently.
Moving right on, the Japanese Prime Minister has landed in India for a two-day visit. He's all set to meet the Prime Minister, and the two leaders are going to be discussing a slew of matters ranging from bilateral relations to cooperation between the G7 and G20. Do remember, Tokyo holds the G7 presidency and New Delhi holds the G20 presidency this year. Meantime, entertainment conglomerate Disney has joined the slew of companies laying off employees, as the company is now mulling a layoff of as many as 4,000 employees in April. This comes at a time after they've already eliminated 7,000 roles in the month of February, and sources say that they've directed managers to propose budget cuts and compile a list of employees that will be laid off within the coming weeks. And back home, the national capital braces for heavy rains as the IMD has issued an orange alert from today. The Met Department has said that there will be heavy rains in New Delhi coupled with gusty winds of up to 40 kilometers per hour, along with hail as well in some areas. Okay, let's look at some of the stocks which are likely to buzz around on news flow today as well. We were talking about the HDFC twins, so let's see if in the pre-open they are making a big move. Canfin Homes as well, if that is making any move at this point of time. And then there was some other news flow happening around RVNL and the other smaller stocks that really deserved mention. For now, my screen is up.
spotting Angel One, which is showing a decline of around 8% in PVR too. But of course, we'll let the rates settle. And Manappuram Finance was also showing quite a bit of traction. In fact, since we were talking about PVR, Neeraj wanted your take regarding these multiplexes names. PVR, in fact, there's just one company left for now. And even the discretionary spend when it comes to travel as well, because the headlines are suggesting that there is big spend happening on travel as well. Would you want to bet on the aviation companies also?
I think entertainment space is one, multiplexes is one where we've seen a lot of good releases also, which will aid their volumes and their top line. So this quarter can be good for them. So I think I would play my bets more with the multiplexes, and I think as far as the travel is concerned, I think we may have seen that peak which happened during end of the year. So that may have already happened for them. And now I think again we are entering some sort of a lean period as far as travel is concerned. So you may not get those incremental, forward-looking for the next 3-4 months. Maybe that kind of a incremental upside that we've seen lately may not come. So I'll more go with the multiplexes in the entertainment segment right now.
Right, we'll have to wait and watch as well for the slew of releases and hope for some better content as well from those multiplexes. Neeraj, thanks so much then for joining in. Let's move right on. Index calls, what are they this morning? Let's find out what our chartists are betting on. It seems to be pretty much tilted towards a hold call on the index, largely owing to the kind of choppiness as well that we're seeing across the globe. Though Kush sticks his neck out, he believes that it's a buy on the Nifty this morning. But the market moodometer, or the consensus call on the Nifty this Monday, is clearly a hold recommendation. Moving on then to the Nifty Bank Index. Remember, it shaved off about 2% in the week gone by. And you've got Nooresh and Kunal who continue to maintain their hold stance on the Nifty Bank. Kush has a buy rating or a recommendation, and it's a hold call there on the Nifty Bank.
Okay, so the HDFC Nifty for now was suggesting that we'll start around that 17,060 thereabouts, and that's what the pre-open rate has also settled at, around 17,060 on the Nifty. Kunal, what would be your trade if we open around that 17,060 mark and we stabilize? There is no further pressure coming in on the markets. Would it be a much clearer call to buy till 17,200?
So I look at it this way, Nisha, that on Friday we were almost at 16,900 on the index. We had a buy call on the index on Friday because of the expectation that the market would get into a recovery or a bounce. The bounce was very strong in the second half, and we closed above that 17,100 on the Nifty. So I think on the futures we were almost at 17,150 on the futures. So after such a kind of a strong recovery, it's bound to be that the markets will probably stabilize at the 17,000, 17,100 levels. For traders who would probably have missed out on buying the index on Friday, then I think at current levels, maybe a dip of another 40-50 points, say at 17,000 20-30 mark for the Nifty on futures level, that could be a very good level to initiate a long, because my sense is that this bounce could probably last for at least another 3 to 4 trading sessions, and it could materialize on the Nifty going back towards 17,250 to 300 levels over the next couple of days. So I would be on the bullish stance, at least playing for a bounce, and any dips closer to that 17,000 level should be taken as an opportunity to buy.
Okay, that's the view coming in from Kunal on the Nifty. Meantime, Nooresh, let's get in your take then on what the outlook is when it comes to the Nifty IT index.
So in terms of Nifty IT index, it's become difficult to take a call on the whole index as such. The view is to now go stock specific. The Nifty IT index could continue in a sideways zone only. There could be stocks which could make a leadership move. So for example, Wipro is at a 52-week low. Infosys very close to the last 6 months low. But that is not the case with the Tech Mahindra or TCS. Same as in the mid-cap space. But if we look at only at the Nifty IT index, the low was around say 26,500 in September. The peak was 31,000 in the last 6 to 12 months. I would expect now a new base to be at 28,000 for the IT pack, the Nifty IT index, and 31,000 on the upside. So till the time we are in this band, time to stay stock specific. It's only when we start crossing that 31,000 mark on the Nifty IT index, then maybe can take the call on the whole sector as such. But right now, be stock specific on the IT names. The index could continue to be in a range of 10% for a very long period of time.
All right, there you have it. Be stock specific. That's the view coming in on the Nifty IT index. Just about 30 seconds to go for the market open. Do remember, we've got a slew of top data points that we'll be watching out for very closely. It's going to be what the US Fed does as well. Last week, we underperformed our peers. We were down about 1.8%. You had Adani Group stocks. The OMCs, they managed to outperform. Banks, telecom, IT, as well as autos were the top drags. When we're looking at the 10-year bond yield, that fell about 7 basis points. And you had FIIs as well, which continued to remain net sellers in the market. Bracing ourselves for perhaps a tempered start owing to what the rest of the globe has thrown up. Do remember, we do have the bailout of those banks coming in that hasn't provided much relief on global markets. But that's the initial tick this morning, or the opening trade. 17,000 being held on to, but a far cry from the 17,100 mark. We're down 0.5% for the net Sensex as well as the Nifty. For the Sensex, 358 points shaved off. The broader markets, in comparison, it's a fall that's far more measured, so just down about 0.33%. To the big losers then, and the metals index loses out the most. Media in the red, IT, PSU banks, not to mention the Nifty Bank on the back foot, down about 0.7%. Let's just quickly take it to some of the Nifty drags. Adani Enterprises, TCS, IndusInd Bank, Maruti, HDFC Life, Tata Steel, those are some of the drags in trade. To the newsmakers then, HDFC Bank, merit to mention the NCLT approving the merger between both the banks on Friday afternoon, and those stocks reacting. Meantime, Tata Consumer, remember we've got that news as well that the negotiations with Bisleri for that potential acquisition as of now have been called off. Canfin Homes, they've appointed the former Bandhan Bank Housing Finance head, Suresh Iyer, will be taking over as the CEO. You got GMR Infra as well. They're going to raise close to 2,900 crores via the FCCB route. A quick check-in on that stock. Cochin Shipyard, it's a project that they've bagged worth about 550 odd crore rupees. Godrej has approved a share buyback via the tender offer route. Take a look at Sumitomo Chemicals as well, as the Pollution Control Board has revoked the closure order for their Bhavnagar production site. A quick check-in on Adani Enterprises as well, as we understand that their petchem projects, according to reports, have been suspended. Biocon as well, they've sold some shares as well at about 200 rupees per share that have been sold in the counter, while Bliss GVS is on the spotlight as the US FDA has issued a Form 483 on their Palghar unit. Within the broader markets as well, just going to take a look at the movers. We've got a downtick of about 0.5% or so for the mid and small caps. The Adani group of stocks, something like Ujjivan, BASF, Infi, HAL. And on the flip side, you've got Cochin Shipyard gaining smartly. Blue Star, Responsive Industries, Rail Vikas Nigam continues its upward move, and you've got a Manappuram Finance in the green. Kunal, sub 17K on the index, and it's just been 2 minutes that we've started off trade. What's your view on levels, and take us through your first trade, of course?
So, yeah, I think it's an at par, start what we were expecting. The index down some 100 odd points on the Nifty. I would expect 17,020 to be a good level to initiate a contra buy on the Nifty futures for intraday traders. So I'll wait for maybe another 20-30 points on the downside to initiate a buy. Now, in terms of stocks, Tech Mahindra is a stock which I believe looks very attractive. The stock is heading towards a breakout about that 1150 mark. The stock has gone through a multiple test of those levels. So I believe an eventual breakout is something which I believe looks attractive from a trend setup for Tech Mahindra. That's a stock which I'll look to buy.
Okay, so Tech Mahindra is something that is definitely catching attention of Kunal. But just in terms of some of the other stocks that I wanted to flag out, Cochin Shipyard we have talked about because of the big order that they have backed, so a 5% move coming in there. And you also have Kalyan Jewelers, which is showing quite a bit of traction, 3% higher. Biocon, remember there was a fresh note coming in from Morgan Stanley, wherein they believe that the share price will rise in absolute terms over the next 15 days. So it's a bit of a positive catalyst watch coming in for Biocon from Morgan Stanley, and the stock usually reacts on account of that. So today as well, Biocon is up around 3% on account of that particular brokerage note. On the losing side, it's the Adani group of counters that continue to really under pressure. Gas, transmission, green, they're all down and out. Enterprises we flagged out, and also Jubilant Life staying with a cut of around 3.5%. But Nooresh, what about your first trades? Is there any stock that is catching your attention at this point of time as a good trade?
So that would be L&T. The stock is shaping up for an eventual breakout about 2200, 2220 level. So today's dip is a good entry point at 2180. Expecting it to break out going forward. Been the best performing stock in the large cap as of now. Over the last few sessions has not corrected. So like L&T for the short term.
Okay, there you have it. Those are the first trades that our chartists are betting on.